Investors in emerging market equities have become increasingly worried about the ongoing regulatory tightening going on in China. Is it time to exit emerging markets? Let's break it down. So to set the stage, the changes to the Chinese regulatory landscape are meaningful. We're seeing a crackdown across industries, everything from ride-sharing to e-commerce to online education, and most recently to automotive semiconductor manufacturing. As you can see, this cuts across lots of different businesses and lots of different sectors. The motivation may be aimed at controlling the ownership and distribution of data, or, as apparently is the case with the clampdown on virtual tutoring, an attempt to alleviate something that's become a pretty big financial burden on middle-class Chinese families, and that's something that authorities worry will undermine the impact and success of their recently announced three-child policy. As we've noted before, China is not immune to the global aging population trend and demographic challenges. So to the extent that regulatory tightening is aligned with advancing these strategic goals, it certainly will continue. And it matters. Most popular emerging market benchmarks have significant exposure to China and to Chinese companies. The most popular, the MSCI EM index, has nearly a third weighting to China, and 3 of the top 5 holdings are Chinese. Unlike developed ex-US and the S&P 500, the emerging market index sits below the high reached earlier this year and has significantly underperformed its developed market peers. So the market has already clearly repriced risk, particularly in China. So what does it mean for investors? Well, it's going to create ongoing uncertainty across a large part of the emerging market investable universe. The market, though, has already demanded a higher risk premium as compensation for taking on that heightened degree of regulatory risk. This discount's going to be persistent. We're mindful, though, that it's also going to be important for China to maintain financial stability as a policy goal, so we don't think the pendulum's going to be allowed to sway too far before we see policy intervention designed to offset. Most likely a looser fiscal policy, perhaps even monetary policy stimulus. At the same time, China's now struggling with the surge and the Delta variant of the coronavirus. That makes policy intervention even more likely. This is going to be supportive to Chinese equities. For long-term investors, we recommend staying the course with emerging market equities. We're mindful, though, that we're in a period of more unpredictability, and that's going to usher in more volatility.